All right. Well, we bumped up in order of magnitude, so I'm gonna say let's get going. Thank you very much for joining us today. My name is Ryan Nash. I'm the CEO of Gust. I am joined by Peter Swan, our CEO, and we're pretty psyched to do another one of these. This is actually one of our most popular educational webinars that we do. But Pete and I were just talking earlier today, going through the ever iterations on the deck. It is starting to culminate, a year's worth of expertise and storytelling and founder support that we have done through our mission control program. And I'm just really excited to share it with everybody today because I think every time we do this is getting better. It's more tactical information to really, really help cut through the noise about what it takes to get a startup off the ground, especially during that really tough pre-seed era, which, just doesn't make the press like the Forbes or the TechCrunch articles of like, double digit valuations and huge rounds. It's like the nitty gritty stuff. So Pete's going to lead us with a presentation, and we will have time for Q&A at the end. And as always, we are recording this. If you RSVP'd, if you're here right now, or even if your friend or your co-founder RSVP'd, you will get a link to the recording by tomorrow, so you can rewatch this. As always, looking forward to helping you all on your startup journey. And Pete, take us away.
Cool. So yeah, as Ryan said, today we are going to be talking through what we consider to be a tactical guide to pre-seed fundraising. And as you said, this is kind of cobbled together with a new perspective, very much founder focused, based on the work that we've been doing through Mission Control, which is very much trying to help pre-seed founders accelerate their journey towards fundraising. And then also the work we've been doing with Gust's new Angel Collective, which is designed to help new angel investors get started. So the experience we're seeing in looking at pre-seed deals there, and what's hitting and what isn't. So this is kind of a combination of both those perspectives meant to really help you conceive of this from a step-by-step perspective. Because
Before you
as we see,
dive in, Pete, can you actually unlock the chat? It's only for hosts and panelists. So if you guys have questions throughout, use the Q&A functionality that should be open, and we'll open up the chat in just a second so that everybody can
yeah,
use the chat.
absolutely.
There's three dots somewhere, and
Sorry about that. Attendees can chat with everyone. Panelists can chat with everyone. Okay, someday we'll just get the default settings on Zoom correct.
here we go.
All right, all good?
Yep.
Okay, so back to it. So pre-seed fundraising is super tricky, and we run into a whole bunch of weird misconceptions and mistakes that people make, really on both sides of the table. And really, to start with that, it's helpful to discuss why pre-seed is hard. And it's really primarily because investor expectations change. And those change because you're going from raising from people that you know really, really well in like a friends and family and hustle round to semi-professional investors. So pre-seed is probably the first time where you're talking to angel groups or business angels, and the stakes are just fundamentally changing. There's more money at stake. Semi-professional investors are actually going to have an economic focus that your friends and family didn't, and they're going to be betting on more than just you. They're still betting on you, but they're not betting on you in the same way people that you know really, really well are able to and capable of betting on you. And further, they actually have multiple options. When you're talking with your friends and family, your colleagues, your extended network, kind of your hustle around people, they're generally not looking at 40 to 100 startups. They're just looking at yours. So this is when the equation kind of changes completely. So it's really important to align expectations. And it's important to align those expectations because you are now in charge of speaking to the expectations of those people who are potentially going to give you money. And the first place that it's really helpful to align is around angel economics. And these are important because they motivate the entire kind of economic perspective of the angel investors who are potentially going to put money into your startup. And the biggest thing to understand there is that 90% of angel-backed startups fail to generate the type of returns that angels are looking for to actually make their portfolio make sense from an economic standpoint. That means it's 10% of angel-backed companies that actually end up resulting in the type of economic outcomes that make angel investing an investment activity instead of just a hobby. And what that means is that there are growth expectations and very large growth expectations on every one of the companies that an angel invests into. So when an angel investor, an early stage VC invests super early, they're looking for a minimum 30x return on that investment. And that's if we're looking at angels. Early stage VCs may be looking for a return up to 100x. But since we're looking at pre-seed today, we'll focus mostly on that angel outlook for how we continue to explore this. And if we keep pushing through this, you can imagine if you're raising $1 million at a 7 million valuation, you are now setting an expectation that your company can conceivably exit for $240 million or above. And if you're exiting for $240 million or above, looking at kind of median exit multiples right now, that means the expectation is that you're going to build a company that can generate at least $40 million in revenue. And you're likely going to have to do that over the course of roughly 5 years. So if you think about that and extrapolate it all the way back, your job as a founder becomes relatively simple. And your job is to tell a really compelling hard science fiction story about how you are going to build a business that can generate $40 million in revenue. And specifically, how you're going to use the money you're asking for in order to do that. And if we dive into the components of a compelling science fiction when it comes to startups, right? And I think it's important to anchor around this because there's a lot of confusion about why is it helpful to build a compelling science fiction, right? Like a hard science fiction novel isn't easy to write. You have to do a lot of research and you have to put things together in a way that makes sense. And in the early stages of a startup, there can be a lot of reactionary, like, oh, well, why does it make sense to do all of this pre-work to chart this course when everybody acknowledges that it's not true? And yes, everybody acknowledges that you are not going to put together the perfect story. But if you can prove that you can put together a well-researched story that is actually believable, it gives everybody a tremendous amount of confidence that you are capable of doing that activity, really starting with you. But then being able to convince investors of what you've already convinced yourself to believe. So even though everybody acknowledges that it's a fiction, it's a compelling fiction kind of rooted in some reality. So if we break that down into what's required to actually build that compelling science fiction story, startups have to be addressing a big and growing market, or they typically won't make sense to actually pursue the types of revenue stories or exit potential that angel-backed companies need. They need a great team with a capable and trustworthy leader because you can't go on an amazing adventure without that great team. And then they need a compelling plan that's actually rooted in some reality to generate traction in the market. And usually when we interact with startups at this stage, they aren't really having too much trouble with the first three of these, right? They understand that there has to be a big and growing market. They understand that there needs to be a team capable of doing this stuff, and they understand their role as a founder, right? Maybe not quite as a CEO yet, but as a founder at least. It's really in these next three where it gets kind of tricky. Compelling plan, rooted in reality, and actual traction.
Before you move
And
on, Pete, we got a question in the Q&A. I think that's relevant to set the stage for the rest of this. Kenny Pierce asks, why a 30x return? He's heard that angels, that it's 10x and angels are even happy with 5x. Is he wrong there?
well, it depends, right? It depends on what your angels are looking for. And we can share some of the mathematics that we've put together. Generally, 10x and 5x are going to be reserved for people investing at kind of Series A and beyond, right? That's when things are de-risked and you're putting money against something that's working to grow it. So your expectation of the returns is smaller because the rate of failure is lower. So angels who may be investing in later stage deals may only be looking for 5x to 10x, or they may be only looking for 5x to 10x if they're looking at a specific type of company with an exit timeline that is shorter, right? But generally, especially at pre-seed stage, when you're looking at angels writing first checks into startups, you're looking at a 6 to 10 year time horizon, right? And generally, if you're looking at angels who are looking at this as an economic activity, they're trying to generate returns that can beat the market. And the gold standard is a 25% IRR. So if you extrapolate all of that back and you look at the typical failure rate of startups, then your Monte Carlo simulation, when you look at the breakdown of different outcomes, is going to start to look good if you can get 30x returns on companies, and if you can invest in at least 30 of them. There are some investors who will have different targets for that IRR. That 25 is admittedly potentially aggressive, but it can change. But 30x is kind of the number that we anchor around. Some will be happy with 10, but typically you'll see that happiness be associated with kind of early stage VCs at Series A and beyond.
I think it's worth pointing out the term angels has a lot of blurry edges. Angels invest in pre-seed companies, seed companies, and even Series A companies when the opportunities arise for them. And it all depends on their portfolio strategy, their network, and who they kind of associate with. So a lot of times founders get confused when they just hear the general blanket term angels. I'm raising from angels. It's like, well, what's the criteria? Like, why don't angels give me a check for my idea company as opposed to why don't angels give me a check for my company that's generating revenue? And we'll dig into the more specifics as we go on. Thanks, Pete.
Yeah, and this is specifically stage related, right? So pre-seed and seed, 30x or more. All right, cool. So coming back to this and diving into kind of this compelling plan rooted in reality, traction in the market, more in depth, and we'll do it backwards. So the first piece of this is traction, and we see a lot of misunderstanding around this, especially at the pre-seed when traction is scarce. And we have a pretty narrow definition of it. We think of traction as business traction. So something outside the company's control that is demonstrating there is market pull against the actual business, right? So that means things that you can do on your own, going to raise funds, building a product, having a great idea, generating press, filing a patent, getting other people to work on this, marketing activities, acceptance into startup programs, getting AWS credits, acceptance into an accelerator. All of these can be validation against your company's seriousness and can give you kind of a gold star that somebody else has looked at this and kicked the tires on it and thought it was cool and interesting, but none of it is actually a demonstration of business progress. So if we really narrow in on something outside of your control that is demonstrating value to the market, then we get toward things like paying customers or letters of intent, something that somebody has signed that is saying, hey, if you deliver X, I will pay Y for it. And I believe that this is good for not just me, but the entire industry. Forward-looking contracts, pre-sales, users, things that are repeatable and accelerating, and demonstrations of market pull against the business. Now, this can be really tricky at pre-seed because typically at pre-seed, you have very little traction to work with, right? You may have found a problem that you validated within the market. You may now be socializing a solution that you've built a duct tape and glue prototype against. And really, it's not till that seed stage where you're going to be chasing that product market fit, and not till beyond that until you're going to have that product market fit and show repeatable growth. So absent that traction, there's a lot of confusion at the seed stage about, okay, what the heck do we show to show that there's business progress? And that brings us back to our compelling science fiction, starting with a compelling plan. If you don't have traction, you have to have a really compelling plan that explains exactly how you're going to attempt to get it. So coming out with a slide that says, we are raising $1 million to finish our MVP and showing an investor how you're going to spend their money, if you're not doing the work to tie that back to actual valuable business goals and outcomes, it's not going to be enough. If somehow magically at pre-seed you have a ton of traction and it's growing and it's repeating and it's accelerating, then yeah, you can fudge this a little bit because the traction is showing exactly the goals that you're going to be reinforcing. But absent that magical traction early on, you have to show at least a good, concrete, hypothetical plan about how much money, what you're going to use it for, and how you're going to accomplish those things. So if we drill down a little bit more, right, things like we are raising $1 million to finish our MVP, or we are raising $1 million to bring our team on full time. These things are really hard to digest from the perspective of a pre-seed investor looking at a business opportunity or an investment opportunity. It gets much stronger if you can explain the amount of money you're raising and what you intend to do with it. All right, so a quick example here. We're raising 500K to reach our first 10 customers and find a repeatable channel for us to reach our next 100. Right? Immediately more concrete and understanding from the investor perspective what you're going to attempt to do with this money. So you can think about this as kind of a modification of the ask slide, and then we'll look at kind of a modification of the use of funds. All right. Once you know what you're asking for and what you're attempting to do with it, it's also important to have a clear story about how you plan to achieve those goals with that capital. So we will reach these customers in a specific way. We're going to leverage a specific sales strategy, and we're going to use money to test different marketing strategies, right? You can explain this at a high level, but paint a clear picture back to this pie chart. So this pie chart isn't just standing alone as a how I plan to spend all your money. It's a how I plan to spend all your money to accomplish this, to accomplish this. And the last piece to this is actually rooting these things in reality. And we see a lot of common mistakes here. Once you've kind of told the investor what you plan to do and how you plan to do it, they're going to want to understand the specifics underneath that. And a lot of the time we see that this is kind of where founders fall apart. And there's some key common mistakes that kind of give an investor the idea, okay, that maybe you're not really sure what you're going to try to do yet. And one of those is that growth comes from kind of nowhere and everywhere at the same time, right? Instead of being able to say like, okay, we're going to get one customer here by doing these activities, and then maybe two customers here. We're like, well, we have all of these different nebulous opportunities. There's a potential partner strategy, and there might be paid ads, and we're also going to do a content strategy, and we're going to do social. And like all of those are opportunities for our business, right? It's saying like, okay, growth comes from nowhere and everywhere at the same time. You don't know what you're going to try first because you haven't put in the work to figure out economically what might be the most, hypothetically successful or the best ROI. We also often see that growth doesn't respect market constraints. A common mistake is that we'll see somebody just throwing out a growth trajectory that magically gives them 50% of their target market in like 24 months. Right? Just unrealistic growth based on the size of the market and the available people to sell. We also often see things like unrealistic marketing spend or a sales scalability or even sales cycle that doesn't make sense. So remembering that you have roughly 18 to 24 months to put each round of investment to work to achieve something that is going to allow you to raise more money or otherwise allow the business to continue on in growth sustainable in a sustainable way. If you are looking at a B2B or an enterprise sales play, and in the first month you plan to add 5 sales reps before you have a sales strategy, and all of them are going to sell 10 customers, and that revenue is all going to hit in month one, a lot of things don't line up. Right. So it's very important to try to think through all of this from the bottoms up in a way that you are comfortable with how you're going to mobilize that money and for what. You are comfortable that it's realistic and you are comfortable enough with that to express it to somebody else. And that brings us to our favorite tooling to actually support that activity. And there is a lot of controversy as to the efficacy or usefulness of a financial model at the pre-seed level. It is not necessary that you go and work with our friends at Forecaster to put together the best financial model ever. But looking at what financial models look like a step ahead is a really good way to understand how you can leverage that to help you at the pre-seed, which again is make sure the assumptions that you are building on top of are realistic, that you are comfortable that you can achieve them. It's going to be tough, right? It's supposed to be a stretch, but they should be believable. and that you are comfortable enough with that that you can explain it clearly to investors. And the activities of actually coming to that comfort are to break down your revenue streams. What are you going to be selling? How much are you going to be selling it for? And where the heck are your customers going to be coming from? And if they're going to be coming from paid ads, making sure to budget for your paid ads and have a realistic cost of acquisition and think about where it's going to start and where it might get to over the course of 18 months. Um, if you're going to have a sales strategy, understanding that the expectation at pre-seed is likely going to be founder-led sales. How many people can you actually close, and how long will each of those take? Right? Setting realistic expectations that show how things will compound month over the amount of time that you'll be mobilizing investment money from around can be really, really helpful. You don't have to start with the perfect software. You can start with a spreadsheet. You can start with a back of napkin. But the closer you can get to breaking those things down into exactly how you're going to spend that money to find customers at a certain value is extremely helpful, even though everybody recognizes that it's still just a compelling science fiction. And once you can get through all of that stuff, once you have your really good story, once you have narrowed in on what it is you are actually going to try to do with this money, you also want to just avoid some easy no's. And this is all around kind of basic diligence and structuring. And at the pre-seed, your pre-investment kind of diligence checklist is relatively simple. You want to make sure that you actually have a fully formed company that is in good standing. You want to make sure that all of the equity in your company is granted to co-founders, to advisors, to anybody else who's working on the company. Not just promised, actually granted legally with vesting so that you can protect that equity if things don't work out with whoever that person is, and that all intellectual property that those people own who are equity holders is properly assigned to the company. Right? The last thing an investor wants to see is they are coming in and investing in this company because it's going to generate value, but the thing that's going to generate that value isn't actually owned by the company they're investing in. And then last but not least, you want a bank account established. And that's because you don't want to commingle personal funds with business funds, and investors are very unlikely to write a check into your personal R&D LLC or to you personally. You're going to need a company bank account. And taking that step one step further, if you are trying to build a big company that is very likely going to need outside investment, or you are going to use your equity to incentivize employees, it is very likely that your investors will insist at the pre-seed or at the seed that you are organized as a Delaware corporation. And the reason for this is that a corporation is, by its nature, set up as an ideal structure to organize a large number of people in pursuing something big. Right? LLCs are relatively bespoke. They don't naturally have the concept of shares. They are meant to be pass-through entities to the individual members. Corporations have a strict three-level system of company governance, starting with officers overseen by a board of directors, which are then overseen by the shareholders. And corporations are naturally split up into shares, making it very easy, straightforward, and standard to incentivize both the founders, the team members, and the investors with ownership in the company in a way that's predictable, straightforward, standard. And we get a lot of questions about the Delaware nature of this. And obviously, there are some high profile things in the news right now in terms of minority shareholders and rulings in Delaware. But the fact of the matter is, Delaware is still and will likely continue to be the primary place for companies that aspire to be big to incorporate. And the reason is, even though there are other states that have a very, very similar corporate code, the Delaware court system has processed a huge body of cases, establishing a huge body of precedents, giving all of the people who are investing in this giant enterprise a very good idea of not only what the law is, but how it's going to be applied when things happen to the company. So this is tremendously valuable in a super risky venture where there's a lot of uncertainty. the Delaware body of case law just gives everybody confidence in how things are going to work. They may not always like how those things work, but it is clearer how they're going to work in Delaware than nearly anywhere else. Caveat being that if you're still going to go start a crypto startup, there may be reasons to incorporate in Wyoming. There may be reasons to incorporate in Nevada, but by and large, if you are starting a startup that is going to require outside investment, Delaware C Corporation is the way to go. We still see tons of people start as LLCs. You can do it. It is possible to convert. Just remember that the more things you do, the more expensive it is going to be to convert. And there are not a lot of great reasons to not just go with a corporation outright if you are going to pursue something big.
I see you are keeping an eye on the chat.
Oh, I'm not actually.
Oh wow, you're
It
nailing
was just
some of the
a
chatter. Yeah,
perfect.
no, good, good, good.
And then in terms of early no's, you also just want to have an understanding of the structure of these things. Um, there is nothing worse than a founder coming in and speaking to something like they know what it is and having it be incorrect. And one of the biggest misconceptions we see at kind of the earliest stages is early investors don't buy equity. They don't buy shares directly in your company. Very often at the pre-seed and even seed stage, investors invest in what are called convertible instruments. It's essentially money now for equity later. They're much cheaper to transact than an actual sale of shares. And essentially, what happens is investors lock in some reward via a discount or valuation cap. And then when you actually do sell shares at a later date, usually at a round that starts with the word series, so Series A or Series Seed, if you raise a lot of money at the seed stage, all of those shares convert. So all of that money that came in for equity later will convert when you actually do sell shares later down the line. And those investors will get a discount on those shares based on the discount they negotiated or the valuation cap they negotiated in the earlier rounds. And it is important to understand what a valuation cap is. Again, lots of early confusion about this that causes founders to kind of come out with terms that don't necessarily make sense or confuse the terms with other things or pay for things earlier than they should. Um, Basically, the TLDR is don't overcomplicate it. Just like future rounds, the valuation cap math is generally the amount of money that you need to raise um, you know, over the prospective future valuation of the company in a way that gives investors confidence in what percentage of the company they're purchasing. And that percentage is relatively standard, fluctuating anywhere between 10 and 20% per round. So those are your guideposts. Um, Especially if you're early, you are not going to get a lot of points for a discounted cash flow analysis on your financial model. You will likely understand the amount of money you need to raise, understand the amount of your company you're willing to give up to get that, and using those numbers derive a valuation cap. And this evaluation cap is an investor protection. It locks in an advantage for those investors because they are taking an early bet. It is not a point in time valuation of your company. It doesn't value your common stock. And most importantly, it has very, very, very little to do with a 409A valuation. So you should not in any way go and get a 409A valuation in order to justify your valuation cap. It is a waste of money. And it is important to understand these days the difference between a pre-money and a post-money valuation cap. The predominant convertible instrument out there right now is the YC Safe. I believe it's at version 1.2, and it operates with a post-money valuation cap. Essentially, what that means from your perspective as a founder is that the investor is buying the exact percent of the money that they are investing over the valuation cap, and that percentage will be calculated for each investor at the time that instrument converts. What that means for you is that every time you sell more of your company via a post-money valuation cap, that dilution stacks. So your previous investors do not share in the dilution. They all lock in a percentage, and that percentage is additive over time. Not a problem if you understand what's going on, but it can be a problem if you don't understand what's going on Don't plan for, the amount of money that you're going to need prior to conversion, or start mixing instruments in a way that you don't quite understand. And then because it's still going to happen, even though it is early, naturally at the pre-seed stage. Okay, what happens if you still get too early? Because no matter how you slice it, no matter how well you prepare, it's still really hard to raise. As I said at the beginning, one of the key differences moving into pre-seed and working with semi-professional investors is that they have multiple choices. They're not just looking at your company as a potential investment target. They're probably seeing a lot, right? So you will have to have resiliency through this process. And really, there are only two relatively straightforward and simple ways to combat this. The first is to find a business outcome that is valuable that you can pursue with less money. This can be bootstrapping and really focusing in on business goals rather than product development for product development's sake. It can be extending your friends and family into an angel round where you raise 250K to achieve some business outcome, right? So just looking at critically what your financial model says, what your plan says, and say, what can I achieve with the resources I have? And what can I achieve if I raise less money? And are either of those meaningful? And then the second is to just keep top of mind with investors. And this is hugely important. Gil Silberman, who is a longtime contributor to everything we do at Gust, I think called not sending company updates the biggest unforced error he sees with startups and the biggest force multiplier. And all this is taking the information we just talked about, right? The path that you have laid out, what you're attempting to accomplish, and just sending an update on a regular basis to people who care about your company to show that you are making progress, to show that you are tackling new problems, and to keep them up to date on what has changed since the last time they heard from you. This is an important exercise that you need to be doing internally anyway to chart your progress and make sure that you are making progress and encountering new problems, and showing momentum and telling your hero's journey. And if you are already doing that internally, sharing it with your network can be hugely powerful. It allows people to plug in when the time is right. And investors hate nothing more than missing out on a good deal. So if you know they care about your company, if they know they like you, if you can get them to get on your company updates distribution list and you can send those on a regular basis, then chances are you are way more likely to curry their good favor when it is time, get their attention when they see that they can jump in and help, and really start to mobilize your network, even if that network isn't ready to give you straight cash just yet. And last but not least, if you are navigating this, we can help. We have spent the last year putting together a program that we call Mission Control, which is effectively designed to be your fractional co-founder, just offering a community of early stage support, weekly office hours, pitch practice, helping you navigate putting together this story and all of the resources you need to successfully raise. And then if you're just ready to go ahead and start a corporation because you have everything else in line and you don't need our human help, we also build Gust Launch, which will help you incorporate, fully form your company, set up your board of directors, manage your equity, do your 83B elections, all of the boring stuff that is an easy no, to just get it right and keep it simple without a lot of fuss. And that's all I got.
What? It's only been 36 minutes, Pete. How did you do that?
I don't know. I was expecting to be mired in that for at least another 10 based on my run-throughs. But now we have
I
tons
didn't.
of time for Q&A.
Yeah. And I tried my best to withstand the interruption, playing around in the chat too, to help people out with some good questions. So there's some stuff I'll pull out that we can speak to, but the Q&A is lighting up too. All right. First one is from Steve. Oh, hey, Steve. Can you provide typical asks of friends and family pre-seed and seed rounds with expected returns from companies that we've been involved with over the year, preferring SaaS and AI comps? You can speak a little to that.
Yeah, I mean, it's tough to say exactly. Like I can't give you the phrase by phrase asks because they're not in my head. But really the important thing to focus on is an important business outcome, right? And the reason that that is, or I guess what we have begun to focus on when we're looking at things as actual investment targets is, okay, do they know how they're going to use the money? Not just how they're going to spend it, but what they're actually going to use it for, right? Do they understand what the goal is for the next 18 months from a business metric standpoint? And do those things align, right? If they're asking for way too much money to achieve their business goals, or they're asking for way too little, or there aren't any business goals, or there's not a clear path. And we say, like, okay, how do you plan to use this money? What can we expect to see in 18 months? And the answer is nothing. Radio silence, dodging, right? Those are the things that we're looking for people to be able to speak to. And it depends on your business model, right? If you are a consumer app, then it's fine. You can tell us that you plan to hit X number of users and you want that to grow Y month over month. And these are the channels you plan to hit them with. And then this is how you plan to monetize them, 2 years down the road. And that's fine. We just want to see the plan and we want the plan to make sense against the business model you're pursuing.
And I think in terms of typical asks, um, over the last year, I would say AI companies have a bit of a premium just because there's buzz in there. So you might see, normal pre-seed valuations are in single digit millions. And I think some AI companies with some buzz, and if the founder, like Pete said, all those, if you have leverage, you might see it bigger. But the market moves in cycles. So a lot of times there's a technology or two that are hot. They can add a couple million to the valuation when they're raising because the investor appetite is there. But on the long stretch of things, it's really more about the principles of the business and what you need the money for. So you might be able to attach a premium to it. Caveat and asterisk based on the early part of the presentation that Pete gave, bumping up your valuation just for the sake of having a larger valuation, especially early on, is not always in your best interest. Because as soon as you get a high valuation that implies a high return, you might cut off a lot of optionality in terms of the paths for your company, right? If you raise your seedish round at like a $15 million valuation, you are on the rocket ship or bust, because that means all follow-on rounds need to increase that valuation to meet investors' return expectations. Where if you find yourself in a business model that could be sustainable or could be very, profitable but slower growing, your investors and the type of investors you have might not be interested in you pursuing that because they're looking to make their returns. So setting the valuation cap strategically between you and your investors is something you should put some time into and not just think that always higher valuation equals better.
Yeah, I guess just in terms of flat asks, we've seen just like the money ask float around 1 to 1.5 for pre-seed. But I think one of the things that is tricky, and maybe I can go back and hit this. All right, if you look at this, right, I think most often where we've seen the trouble is that somebody's cash ask is right in the middle of this, 500K to 2 million, but their like story and where they are as a business is right on the cusp of this 500K, right? So I think a lot of people are attempting to raise pre-seed when they're kind of in the middle of these two between problem market fit and solution market fit. So, I think there's an unseen stage, whether it is, angel or, low end of pre-seed here, that is important. And that is kind of coming back from our perspective, based on the capital environment.
Cool. Right on this screen, James Tillman asks, is it okay to cross over the 500K in a friends and family hustle round?
Yeah, I mean, absolutely. None of these numbers are like hard and fast. They are just industry norms, and they fluctuate, although they don't actually fluctuate as much as anyone would like to have you believe, right? So if you don't have to go to institutional players or angel groups, or those people happen to be in your friends and family or secondary network, then sure, like you can raise whatever you want from whom. But there are important considerations, right? Friends and family tend to be less sophisticated investors. Early angels tend to invest as individuals rather than with their group. And that can change a few different dynamics. One is how strategically helpful they can be in terms of the networks that they have access to or the skills they have to help advise your company and help it grow. And the second is access to future capital, right? At each round, you want to, if you are really going to go on kind of the VC train and continue to raise, um, part of the way that that happens is investors from this round will potentially invest in your next round. And if they can lead it because they have a ton of money, great. So that is another thing to think about is existing investors being either bridge or next round capital sources. Keeping in mind the caveat that if they can be next round capital sources and lead you around and they don't, that is also a potential problem.
Sorry, I'm going to ask this question just because it's so amusing to me. Thank you so much, James. Why does the hustle around say no cap? I'm presuming it's not Gen Z slang.
It is definitely not Gen Z slang, but yes, excellent question. So typically what happens with a convertible instrument, a safe or a convertible note early on. As Ryan mentioned, as soon as you put a valuation cap or later a valuation on the company, the hope is and the expectation is that the next round, the valuation or valuation cap will be significantly higher, right? So whenever you put a valuation cap or a valuation on the company, you are pegging the growth that you need to surpass in with the capital that you're raising, right? In the early stages, when you are doing this with friends and family who may be less sophisticated investors, you typically want to avoid setting that cap, right? Because you don't want to peg what your growth is super early when you are also working with people who aren't experienced in setting that cap. And often, this early hustle round doesn't follow the same dynamics in terms of percentage ownership as the later rounds. So even that equation kind of breaks down. So what you will often do is use a safe or a convertible note, both convertible instruments that encode a discount for those investors without setting the valuation cap. And for Gus fundraising instruments in particular, we have a version of the safe that has just a discount without a cap, but then what we call a roll-up provision. And what that means is if you use a Gus safe to bring in friends and family investors on a no cap, just discount safe, when you go and raise on a convertible instrument that does have a cap, all of those early investors will roll up into that instrument. So it keeps the cap table cleaner, helps the investors, early investors take advantage of what the later investors negotiate, but really meant for people who are investing at a point where either they're incapable of negotiating the cap or it doesn't make sense.
Hopefully that helps, James. We are swimming in Jimmy's over here. There are so many Jameses in the chat. I'm sorry if I lose track of you. We have a ton of questions, so we still got 15 minutes here. We're going to get through as many as we can, but I'm going to caveat this all by we're not going to be able to answer everything, but we'll try to get as much as we can. Jordan asked back when we were talking about C corps, should you convert from an LLC to a C corp pre-raise or during your raise?
Well, there's no real hard and fast answer on this, just like everything else in startups, right? Um, the most predominant advice you will get out there from professional angels and people who have been doing this for a long time is if you intend to build something big and you have signs that you are making progress toward building that and you are comfortable saying yes, that is true and that's what I'm pursuing, then converting earlier rather than later is helpful. The reason being is that, you know, so many things just start to attach themselves to the company as it grows and as it develops traction. That can be employees, that can be significant contracts, that can be your whole HR and employment tax apparatus. All of these things accumulate around the company, and it's those things that make it more expensive and time consuming to affect the conversion. So if you believe this is the path, it's usually best to just get it out of the way. That said, amazing traction fixes everything. And if you are just crushing it on growth and you can convince investors to invest in your LLC, or they will wait around until you do the conversion. So typically what happens is like, okay, yeah, we know we need to do it, but, and then the process doesn't start until there's capital committed, and then the process takes longer than expected, because nobody actually planned for it because everything was so uncertain, and then the deal dies. Um, but on the other hand, if you have amazing traction and everybody's willing to just wait around and pay for it, um, everything can be fixed as soon as more value is created. So it's tough to weigh. Um, and as always, our perspective is go build your business, but your life will be easier, um, if things go the way you want them to, if you convert earlier.
Yeah, and it's a resource thing. Like it's cheaper than ever to get some of this stuff done. So like if, we convert LLCs to Gus Launch, we charge a little bit more because it does take some work on our end, but it's like all in $1,500 to get yourself set up right. If that's not painful to your company and you're intending to raise funds and you have the resources to do it, might as well clean your house first and then go out with a dedicated fundraising effort where all the ducks are in the row. But if you want to see, building traction first, if there's a ton of other things to de-risk and capital is tight, you can delay it to get more signal from the market before committing to that kind of thing. All right. Robert, you asked what is a realistic marketing spend? I don't know the context of that though. So if you could add more or do another Q&A, we can help out with that. Kenny asked if I raise some pre-seed money for my LLC, how do I convert? I'll answer that because Pete's been talking so much. Usually the caveat or the proper response is you find a lawyer and figure it out. We can actually help. We have a good blog post I'll dig up about what an LLC conversion is like. There's something called statutory conversion, which I think a little over half the states in the United States support, which is kind of a streamlined way to convert a foreign entity, which is an entity outside of Delaware or a non-C corp, into a C corp structure. The basics are you consult the local laws of your LLC. You prep a plan of conversion, which you don't have to share with Delaware, but it might require you to do something with the local LLC, like file a conversion event or something like that. And at the moment you incorporate the Delaware C corp, you say I'm converting an entity. I've done all the conversion planning. In Delaware, this is what I'm doing. We can help facilitate that kind of stuff. So if you're in that situation, reach out to us afterwards. We'll send the recording from emails and whatnot, and we might be able to help you out. Oh, here's a good one, Pete. How are you supposed to build a team with no capital to pay them?
Well, um, your co-founding team are the people who are doing this with blood, sweat, and tears, based on the potential huge upside of this thing. And it's just like anything else. If you're excited enough to do this and risk everything for it, then you at least have the bones of the story to tell to convince other people to risk everything, to do this. Sometimes folks will work for equity, even if they are contractors. Um, but basically, your job is to tell them the same compelling science fiction with a slightly different bent in terms of why it should be worth it for them, in terms of impact to the world, their personal happiness, and what the economic upside might look like for them. It's really tough and it's tough to navigate. But luckily as well, we live in an age where creating software and creating product is cheaper than ever. So again, it's easier to convince somebody once you have some demonstration that there's a business, right? So if you can go out and build a duct tape and glue thing with Notion, Google Sheets, Bubble, whatever, and show that somebody's willing to engage with it in a way that demonstrates the problem, or maybe somebody's even willing to buy it, it becomes that much easier. If the pitch to your co-founder is, hey, I have so much business at my door that I really need you to come on and build it. And if we can close all that business, here's what the revenue looks like. It's a much easier sell than, hey, I haven't talked to anybody about this, but I have a great idea for a product. Oh, I think we lost your audio, Nash.
Hello.
There it is.
Sorry. The chat is on fire. New. This is a good one from Kenny, who's asking a lot of great questions. Are there impact investor groups, investors who focus on impact, not just technology and returns?
Yes, absolutely. And I will say, like, as a general rule, angels aren't just in it for the money, but they are in it for the money. Anybody who is really an investor is in it for the money. There are absolutely impact groups that lead impact first. That goes for angels and VCs. I think all of them will proudly advertise that. But usually they will also say, like, we believe investing in impact does not impact financial returns. That will be the mantra on the site, especially if they're a VC. Um, so yes, um, but I think most effective is pitching your impact and your business opportunity at the same time. Because if you're just impact, purely impact only, um, then you know you're probably a nonprofit.
Yeah. Hang on, I'm reading up on some of these. We kind of got that one. Here's a good one from Anonymous. How would you angle LOI, which is letter of intent, for companies with no sales yet? We have an LOI that adds up to 250K, but struggle closing large deals.
Hmm. Well, if you have an LOI for 250K, then you kind of have closed a large deal. So congratulations. Repeatability is the key there, though, right? Um, if this is your uncle's company and you went and got an LOI from them and you can't get another one, then you might have some difficulty. Or if the LOI, if you are only going to have a single one and each contract value is truly going to be 250K, if that LOI spells out like a clear pilot and design partnership, um, from an investment perspective, I would think that would be pretty compelling.
Yeah, for other people on the call who might not have done this, letters of intent, often common in like B2P enterprise SaaS things, is you find an organization that wants the solution that you intend to build, and you get them to sign a letter of intent that says, if you provide, X outcome or X solution, I would be willing to do Y for it. And often it's a good way, especially in industries that it's difficult to get revenue. Like most corporate or enterprise customers can't sign contracts with companies that are brand new, but they can more easily sign something like an LOI. So a strategy is common that founders will get a lot of LOIs signed being like, hey, the market wants what I am building, and I just need more funds to finish it and make good on these contracts that I have signed. It's not perfect for all industries or markets.
But yeah, I think there's a couple people in chat that have LOIs but are struggling to, I guess, leverage them. Um, Shoot us an email after we send you the follow-up from this. Maybe we can figure out a way to get you into mission control for a free session and kind of explore that with you and see if we can unlock anything.
Oh yeah, that'd be great. We got a good one from Abalaji. I hope I'm saying that right. Where does the SEC come in this process? it's expensive to pay for lawyers and corporate governance and things like that. When do I have to be concerned about the SEC?
Cool. So as soon as you are raising money for equity in your company, even if it's convertible instruments, you are selling securities. And for the most part, if you are selling securities only to accredited investors and you are not generally soliciting, so you are not sharing the fact that you are raising and the specifics of that raise with people who you don't know and who you don't understand the accreditation status of, you are generally covered under Reg D, usually 506B. And 506B is the exemption that most startup private placements is done under. Um, Technically, you should be filing what's called a Form D with the SEC through the Edgar system to establish safe harbor for that exemption. It is something that not all companies do, but that is the most straightforward avenue. Um, I did see an unaccredited investor question pop through in the chat. TLDR on that is it's very hard to take unaccredited money into your startup for equity, but we don't have time to dive into the specifics and details of that. Um, did I get all of that?
I think so.
Cool. And generally, if you're going to raise more than 250K and you're really doing this thing, it's time to find a good startup lawyer. They
For
will
sure.
work on deferred billing, um, and you'll be fine. You will need a good startup lawyer. It is a necessity. Um,
Yeah, and get into our ecosystem because what we aim to do is not replace lawyers with either mission control or Gus launch, but rather augment the parts of their job that are largely not giving legal advice and rather just educating, which is really not honestly in their best interest because it's not where their expertise is best leveraged, and your best interest because lawyers are very expensive, $600 to $1,200, an hour in billable time. So we try to fill that gap, but we have a whole roster of law firms that are super startup familiar. So when your question bumps up against the edge of like, oh, you should really talk to an attorney, not only can we give you a great selection of quality vetted law firms, we can actually make a free intro, and they discount your legal bill a little bit too. It's not much, but it's enough to be a nice perk. Madeline asks a good question. She's at the hustle stage, raising capital through friends and family. What is the typical amount of stake that we should be offering each investor or ownership percentage?
so if it's truly friends and family and it's an early round, they typically won't be buying a direct ownership percentage because they're not going to be buying stock. Most typically for friends and family investors at the early stages, they would be contributing money in to some sort of convertible instrument. Um, it is possible to go different routes, even selling common stock, but those routes are pretty fraught um, with tax and other complications for the company. So just be careful if you're going to go that route. Um, And another route that a lot of startups take is if it is truly from friends and family, and they are not accredited investors, and they don't typically invest in startups. Um, it is not uncommon for that money to come to the founders through a personal loan and have the founders contribute that money to the company. Caveating that this is not legal and tax advice. If you're going to go that route or really any other when friends and family are concerned, it's good to have some guardrails.
Excellent. All right. Well, we just hit time. I know we have a bunch of additional questions that I'm sorry we're not going to be able to get to all of them, but this is what we do. If you found this valuable, thank you very much for the appreciation in the chat. Pete and I are excited about boring stuff. If you've been to some other events, we really like to dig into the details of what's important, explain this stuff, be the translation layer for founders, and really help them level up so they can focus on building a good business. And this is what we do every day through our software, through our communities. I'll throw some links in the chat, and we will send one when we follow up. If this stuff is interesting, check out Mission Control. It is literally this on a weekly basis in a smaller audience session where we don't have hundreds of people asking questions. We have dozens. And then if you're ready to do an actual Delaware C Corp, Gus Launch will save you a ton of time and money. And probably the biggest thing is just mistakes. By being kind of like smart defaults and guardrails, it allows most founders who aren't already immediately familiar with this stuff not to just stumble over, silly trip ups that are very easy to make. A lot of people are posting stuff in the chat, which I think is a tough part about our industry is the stuff that makes headlines is usually the extreme outlier scenarios, but then that information trickles down into founders who are just getting started. So like the ideas of OpenAI's nonprofit status switching and whether there was lies in boardroom arguments and people getting kicked out and then put back on like a week later, like that's the stuff for the drama. But in reality, those aren't the things you need to be thinking about as you're starting a company. A lot of the principles and the best practices are actually fairly straightforward. They're not exactly simple to understand, but we kind of try to help through all the stuff that we do. And we'll do more of these. It is our goal in 2025 to reach out to our overall audience and do our content programming more often rather than pulling together our network and partners, but we'll do all that stuff too. So Pete, thank you so much for condensing all that information down into literally 35 minutes. It's getting better every time. Everybody in the chat, the questions are awesome. The enthusiasm's great. We really like you guys. We love founders almost pathologically. So look for follow-ups on this. We'll send recordings out tomorrow and a bunch of resources and all the stuff that we talked about. Any parting words, Pete?
No, thanks everybody. Appreciate you being here. Hope it was helpful.